Welcome to Insights. I'm Eric. Thanks for stopping by. Today, we're going to talk about the financials because social media, every media is out there. It doesn't turn on your phone, computer, tablet, whatever you're seeing to use to get out there and look around. It's a banking crisis contagion, or at least that's what everyone's talking about to get the clicks. I could care less about the clicks. Actually, I wouldn't mind people watching this stuff because it's important because the invisible hand is coming for you. And I've been saying this long before any bank is going down. This is all that's small potatoes. It's the tip of the iceberg. But people are talking about we're ready for depression too, and it's actually would be depression 3.0 since there's been two in the United States already. But most people don't do their homework, so they think it's going to be just second depression. But it would be the third, and this one would be much more devastating because this is a public sector default rather than something that's taking place privately. It'll be more like Depression 2.0 versus the first one. That was the Long Depression. But this time around, the United States is a net debtor rather than a net creditor, so we're not going to come out the same way. Now we're going to talk a little bit about the financials, and we'll leave this open. I would advise everybody who's subscribing to the Matrix to take a look at the economy and stock report. We dig into this much deeper. We talk about what's going on. We talk about Silicon Bank Group, or well, it's actually a financial group, but they're calling it a bank. It's not really a bank. It's not like you're going down there to count out your change. The retail deposits are slim and none. It's more like it's more like a bad bet in a hedge fund. It's not quite like long-term capital management. People are worried that it's going to morph into something bigger. It's possible. It depends on how many tentacles are connected. But we're going to talk about here about what they're already trying to do about it and what they're going to. Sweep it under the rug is going to be. It's going to be difficult to have the implosion take place in the United States. That's not how the chain of events goes. It's going to happen in the periphery. It's going to move to the core. Core is inside the United States. It'll be the last to fall. But there is danger that this will trigger off, or anything will trigger off something within the periphery. And if you're watching this outside the United States and you're not prepared or ready, then I guess there's probably some rude awakenings that's going to take place between here and the end of the decade. So it's time to start to familiarize yourself. In terms of what we're going to talk about today, we're going to talk about the financial group. I'd say the Silicon Valley Bank or financial group is probably loosely associated with that, although this is more of the big banks. We talk about more how this breaks down in the economy and stock report and how uh, SVB, which was the tickers, I think it's SIVB, falls down in the spectrum in terms of some of its book and its risk profile. Why it's a little bit more unique than people are giving it. I mean, they're just lumping it all into a bank. And I mean, if you're running down to your credit union now because you're seeing this and taking out your money, it's a bit premature. But that doesn't mean that it's not smart to have all your money sitting in a bank. Not with what's coming, but just this is down the line. And the down the line is coming about 10 years from now. Actually, about 8 years from now, maybe 10. You should be prepared, and it's time to prepare yourself. So you take a look at the headlines that freaks everyone out. Reuters carries the demise. Who knows what they're going to blame it on? Show people lines, and then social media jumps on it and says we're right next to a depression. I threw this inside the computer, and Matrix spit out it. It's meaningless. I replaced it with ARC here, but this is SIVB group. You can see the primary trend's been down a long time. Okay, rule number one is don't fight the primary trend. Yes, many people fight it. When you fight the primary trend, disaster happens, and this is another layer of the disaster. Green boxes are bull faces. That's where you're not too worried about it, and anything that's unshaded is problems. Best case scenario, or worst case scenario, you sell everything. Best case scenario, you sit on the sidelines when you go in an unshaded box. That's just works with anything inside the matrix, but that rule gets violated all the time. As I said, if you go onto social media, which is the echo chamber of the mind apparently, and a hollow mind most of the time, what's taking place is the tip of the iceberg. and this is what everyone waves their hands about. But the problem is underneath, and it's way down there. This is debt. This is debt. We've seen this before. Anybody who's watched Insights, watched our channel on YouTube, or any of this has seen this chart. This is the debt, credit market debt relative to GDP. And if you haven't figured it out, it doesn't take much. You pretty much can realize it's out of control. I know that if anyone, there's a lot of explanations of return to the gold standard, but that's not that simple. I mean, that's a simple argument meant to say that gold's going to a bazillion, or you all wave to say Bitcoin's taken over the world, but that's not what's going to take place. This will default and devalue and come down, and it's devaluation is usually how they do it. There's other ways as well. I don't talk about them here, but we're at levels that are higher than the Great Depression already in terms of about the debt pile. It's really a debt cone. Debt cone's huge, and it's dangerous. And as we approach the cycle windows, most notable in 2024, and then the end of the decade, there's another one. Then the real risk is that it starts to unwind. As it unwinds, then Depression 3.0 comes. That's it, or whatever they talk about it on social media, 2.0, but it's really 3.0. Then it comes. It'll be dangerous. You probably won't be prepared for it. You're going to want to be off the grid, to speak, and they'll try and shove you on there, but all sorts of things will happen. This lays in to central bank digital currencies. We talk about it in the Bitcoin report. There's a lot of things we talk about. I mean, nobody wants to know about Bitcoin because it's not going to the moon, and Tom Brady has been cast off to the curb. Unfortunately, there's still a discussion that takes place there. It's not a favorable discussion if you're blindly bullish all the time. It could still recover, but there's some reality of what's going to take place in the world. I'd suggest tracking that. We'll talk about where central bank digital currencies come into all this, but that is no accident. Now, the primary trends financials, or primary trend for the financials, is also just barely up, but it's now starting to turn down. This is a box. If it finalizes here, and it rolls over, which now we're in the process of doing again. So this is a dangerous environment too. You want to stand to the side at minimum. And this is, if you look over in the matrix, which is here, you can see it right here. The financials is still up, but it wants to flip down next month. So this is a market that's in the process of flipping down. You just can't see it. The computer is not showing it. It just shows the primary trend is up. That's why we see the green box. This is the bigger financials. If this doesn't turn down quickly here and start a flipping progress down, it says that the Fed and everyone, the regulators, will contain this. But the real problem is what's going to take place. This spreads outside the United States into the periphery economies. And there's this, we're talking about the UK in particular. UK is already vulnerable once. It could easily do it again as this spreads around. And this is where you're going to have to watch. And as we said, implosions come from outward to in to the inner circle. It doesn't start in the inner circle. Social media just likes to talk to itself. It doesn't understand that's the process or the chain of events that takes place. And the Fed is the central banker of the world. And I know everyone's crying out for them to lower rates, but give me a break. And this is the spread between really I believe this is the 2-year versus the Fed funds. Now it's back above the dotted line, which means that the Fed is too tight, or is behind the curve. It's too loose. For when it's down below, it's too tight. So the thin red line, which this is looking through Friday's close, it's going to put pressure. But if it's too loose, it's been much looser up here. So I don't know how the Fed's going to adjust any of its shorter term policies based on what took place on Friday. If it's too tight, which it was starting to go a little bit too tight here, look at how far it can drop below the line anyways, and you can extend this chart further back and you can say, well, wait a second, this is not that serious. I mean, it's not super tight. This is not the timeline here, 1850. I don't know what the computer's pulling up on this. This is really from probably 2000. So this is not the setup that we're most interested in terms of the Fed going to panic and cut rates. It's more likely to try and contain it through probably here's this Bloomberg, sweep it under the rug and backstop into deposits into some special entity, try to contain it. It's possible, unless everyone runs out to go pull out their money all over the place for a bank that really wasn't acting like a bank. It was more like a hedge fund with some retail deposits. It's unlikely to go that route, but I wouldn't say anything. We're in a confidence bear phase. We've talked about that. You can watch that any point in time. It's inside the matrix. It's down somewhere right around here. It's bearish confidence. It's starting to transition up, though. That's because the economy is in a different phase than most people realize. It's really slipping towards a bull phase or pushing towards that, which it's inside a bull phase, and now we've gotten rid of the downturn within the bull phase, and then it wants to be restored. The real trouble takes place about 12 to 18 months from now, somewhere in that range. It's coming. I mean, we can watch. We talk about more in the ES report and all the iterations of that, but this is an economy that's not as dangerous in terms of economic activity as people realize, but now we're starting to focus on banks. I guess we're bored talking about the Ukraine war, or the Chinese balloons, or whatever. This is how it's going to go, and we're going to go from one crisis to another because this backdrop is unsustainable. This is the tip of the iceberg. The debt in the West is unmanageable. If you try to use this to time the financial markets, yeah, you don't want the financials to turn down and go into a bear phase. I mean, right now, they're still in a bull phase. It's not doing too well because of what's taking place shorter term. If you lose this and the primary trend turns down, these are the unshaded boxes. It takes some work to turn it back up again. And financials are a leading sector of the stock market, so this doesn't bode well for the S&P 500 or the Dow Industrials or things like that. So you're going to want to keep an eye on that too, but this is going to get interesting at least over the next week or so. The focus should remain outside the United States, and we talk about it in the ES report, and we talk about this more in detail. I don't want this to go too long. I'm going to leave this as a review for the S&P 5 or for the financial S&P financials, and we'll leave it open so people can just get a flavor of what's taking place. This is a distraction. There's a bigger problem. Bank failures is normal. They are going to rise because of what's taking place, but this is not what the crisis is all about. This is not going to be an Lehman event that's going to generate another 2008. That will come, but this is public sector driven. This is totally different than the private sector implosion. As time passes past either 2024 coming up or a little bit down the road, then it's going to get worse. And that's why we talked about a bit in the ES report, people are getting off the grid and people are protecting themselves. People are going to become aware of what the risks are at your bank, what the risks are with your currency. And if you don't have that stuff properly hedged, the invisible hand will teach you, and it'll teach you by taking your money away or whatever the valuation away. That's usually how it works. We're going to try and avoid that. We're going to try and have these reports. We're going to talk about in reviews, but have these report updates, talk about things specifically. There's places to hide and there's ways to do it, and I'm not sure it's going to be in the avenues or into the assets that people are most likely positioned. Gold and silver play a big role in this. They are not ready yet, but they will be at some point. And then the problem is when they're ready, nobody will be able to go get them. If you have any comments or questions about what's going on in the world and banking system, financials, Silicon Valley Bank Group, it's really financial group, but it's a bank, and let us know. It's time to talk about this stuff, time to become aware. Don't sit there and put your head in the sand towards it. It'll just catch up with you later. Thanks for watching, and we'll let you guys know if we see anything important coming up in the coming weeks.